This to me is going to be the biggest credit event of our lives, and it's just getting started. And the bottom line is the Fed is still hiking. So I look at people saying they're getting bullish copper. I'm like, okay, well, good luck. Fed's still hiking. China is still tilting over, and there's a major shift there. And then you look in the macro, okay, that's a problem because they mess with their best customers. They have complete lack of confidence internally, and for good reason. And then you look over at Europe. What's the entire continent of Europe? The PMIs are all negative, below 50, and they're still hiking rates. So this is what you'd expect, I think, in the tail end, the biggest liquidity pump in history that's still dumping, and this is early days. So yes, I've been early, but a few months from now, this should get ugly.
Treasury Secretary Janet Yellen expressed growing confidence that the United States can effectively manage inflation without causing significant harm to the job market. She cited data demonstrating a consistent slowdown in inflation and an influx of job seekers as positive indicators. Yellen stated her optimism, saying, "I am feeling very good about that prediction," when asked about her previous hopes for the U.S. to avoid a recession while still taming consumer price increases. Speaking during an interview aboard her aircraft on her return from the Group of 20 summit in New Delhi, Yellen also downplayed any concerns regarding China's efforts to increase its influence within the BRICS group of major emerging nations. She emphasized that the G20 remains the primary platform for global cooperation. Furthermore, Goldman Sachs Group Incorporated economists have revised their estimation, now indicating just a 15% chance that the U.S. will slide into a recession, down from the previous estimate of 20%. These optimistic signs in the U.S. contrast with disappointing data from China, suggesting that the world's second-largest economy may not reach Beijing's 5% growth target for the year. Mike McGlone shares his perspective on Yellen's comments, expressing concerns that the situation may be more dire than publicly portrayed, suggesting that this could evolve into a significant credit event. Now, let's delve into the video where Mike McGlone discusses his macroeconomic apprehensions.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
The thing I can bring to the table right now this morning is we just got off our macro meeting and it keeps tilting. You know, we have all our major people in BI who don't have positions. That's a cool thing. What I do, I've been both buy side, sell side, trader, non-trader, is I'm not really allowed to trade. So we have very open views. And so Anna Wong says, we're going to have a recession by the end of the year. Yes, we're delayed. Expect negative retail sales this week and expect deflationary forces just to start getting started. That's cars and rent. Our equity strategist says the stock market's consolidating. We get that. Pointed out that the Fed's unlikely to cut rates. Ira Jersey. Our mortgage strategist said we have record low mortgage affordability index. And then our equity, our FX strategist said that we need a dovish adjustment for the Fed for the dollar to stop. So what I like to add to that is I see overwhelming forces now on top of risk assets. And Dave said it, I don't see any chance for the Fed to pivot away from this. They have an 800-pound gorilla on top of the market. And that is, if you just look at the baby step, the next key meeting is not September, but November, is there's a 40% chance they're still going to hike rates. The key question is what takes that away? Maybe they don't hike. The bottom line is risk assets going down will take that away. Maybe, but as Dave said, unless there's a credit event, there won't. But you know, the best way to have a credit event is just have a lower tide. So I look at this as the key thing in the macro is this is all, what's the best leading indicator on the planet? What's it doing again on this Monday morning? Bitcoin is right near, if you close here, where it was this morning, it's going to be the lowest since June. And I completely believe that I'm probably going to write about it, partly because there's still disputes, but there's no other asset I've ever seen that doesn't close down and trades all the time. And it's the best performer ever during a most historic event ever when we had zero interest rates. So I like to tilt over to, I'm getting a lot of people pushing back in my call for crude oil. I'm still very bearish crude oil. I like to point out, well, here's a good bear market. The average price this year is the same as 2007. Like, okay, well, why should I be excited about that? So here's a good bull market. The average price for gold is the highest ever. Well, okay, well, I guess I can get excited about that. Give me a reason for that to change. So in the macro, I see what's happening here is epic historic. I mean, we all know that, and I'm looking at this. Look at it for 10 years from now. What's happening is just look at CPI is going to be the story this week. It's going to come out around 3.6 or so. It's right 3.2. Core is going to be 4%. Means the Fed can't cut because it's their rate, their target's 2%. But if you look back the last time they started cutting during the in 2007, right before the financial crisis, CPI peaked at 5.6%. It's much lower. It's almost half that now at running 3%. Yet they started cutting rates. Why? Because, as Dave mentioned, there was a credit event kicking in. I can see crude oil doing it, going back to what it was before COVID, around $40. I can see S&P 500 going back to around 3,000. Yes, those are far away from now. But in a normal recession, with the Fed still tightening, it's never happened. Okay, what's probably going to happen? And what's the fastest horse in the race? Why shouldn't Bitcoin do the same? So yes, I know the macro. So one thing also is the most widely known, assumed, accepted trade in the history I've ever seen of markets is, yes, it's bullish for Bitcoin when all these ETFs launch. And then I always go back to Benjamin Disraeli, what we anticipate seldom happens.
As U.S. markets zero in on the crucial August inflation update this week, Japan has thrown a curveball into the mix. They've indicated a potential early departure from their easy money policy, just as other G7 central banks are contemplating tightening their monetary stance. In a weekend interview, Bank of Japan Governor Kazu Oda stated that the central bank might consider ending its 7-year-old negative interest rate policy once it nears its 2% inflation target. This suggests that the BOJ is mulling over official interest rate hikes and an early termination of its bond buying yield cap policy. Mike McGlone maintains his bearish outlook for the overall economy, asserting that a correction is likely before any significant rebound to previous levels. Now, let's proceed with the video for further insights.
I'm not just bearish, I'm bearish all risk assets. I mean, literally all of them, because of what's happened historically. I'm saying 10 years from now, if hopefully I'm alive, or 100 years from now, how are we going to view this period in history? And that is, most people who've been trading Bitcoin and cryptos for 10 years don't realize how historic it was. Zero interest rates, negative interest rates in Europe, still in Japan. I mean, it's global, and that's changed, flip of the dime, particularly leading in the largest countries. So I want to start with this, 2.5x. I'll give you that statistic. That is the 2-year note yield in US, how much it is higher than the average of, the weighted average of the top 3 other countries combined: China, Japan, and Germany. Now I said weighted because Japan's a bit distortion because it's so low, but if you take Japan, China, and Germany, their total GDP is about the same as US. Yet our rates are 2.5 times higher. That is an accident that's breaking already. And you're going to see every day that goes by, you're going to see scrambling to do something about it. Like we saw this morning, China's trying to do something, Japan's trying to do something to help support their currencies. It's the force is overwhelming. It's not going, you can't do anything about it. To me, that's what's breaking in the short term. So the key thing is you got to get the monkey, the 800-pound gorilla off the back of all risk assets, and that's the Fed. And I just look at baby steps at a time until you at least see the first sign that they're not going to hike at the next meeting. They might start cutting. And if they cut the first time they do cut, which is not going to happen,
that's the crash.
It takes 2 years. So this is how different and how unusual this is. So if this doesn't happen the way I think it's going to, I'm so happy to have to write those textbooks and I'll look like, yeah, I was completely wrong, all those lessons. But this is where we rope in the minor things, like this morning, you look at Ethereum down almost 2%. Well, that's just the day. You look at compared to Friday, they're down lower because we only have one day here. But that's where the macro is so overwhelming and so significant. And that's one thing I do enjoy when people say, I've been doing this for 20 years. Like, you have to have been doing at least for 30 or 40 years and have experienced bear markets, because 20 years means 2003. That was the best time ever to buy, because what happened was in the back of a very bad bear market that collapsed, massive liquidity, and boom, it's time to buy. And then we had the crisis during 2007, 8, 9, massive liquidity. I just keep looking at markets rolling over, still rolling over, and the Fed's still hiking. That's not that complicated. Turn off CNBC, 2-year notes at 5%. Thank you very much. See you in 2 years. I think I'm at least ahead of the game on is trying to predict when markets start showing divergent strength or weakness. And I completely agree with Dave. I have for a while that Bitcoin is going to trade more like risk-off asset treasuries and gold. But the signs are it's not. It's still actually doing the opposite until I start seeing signs of that. Again, this morning, it might take a while. And that's why I'm worried it's going to have to get really low and cheap before it starts doing that. And everything, I think, it's going to have to get low and cheap before people realize, okay, this asset, which is unstoppable, unlimited demand and unlimited demand, decreasing supply, it's gonna at least show those signs of strength. Show me the beef first. And that's, again, I just look at it on a 2-year basis. It's down, 30-something%, and the stock market's basically unchanged. It's like, come on, it's down. Okay, Bitcoin's down 42%. S&P is unchanged on a 2-year basis. On a 1-year basis, same. It's still underperforming. You have to risk adjust that. So typically, Bitcoin used to be 10x the volatility of the stock market. Now it's like 2 to 3x, depending on which index you're looking at. It should outperform on the way up and outperform on the way down. It's underperforming on the way up, and it's still outperforming on the way down. At least show me signs of that divergent strength. It's not doing it yet. Maybe when the ETFs are launched, but that's a known. We all know it's coming.
Germany is currently grappling with the prospect of a recession in its extensive industrial sector, coupled with lackluster export performance. These challenges are casting a substantial shadow over the entire economy. In its report, the Commission highlighted the weakness in manufacturing and underscored how Germany has been particularly affected by energy price shocks associated with the conflict in Ukraine. Additionally, the European Central Bank's efforts to curb inflation through interest rate hikes have also contributed to the slowdown across the Eurozone. These concerns come just before the ECB convenes to decide on whether to further increase borrowing costs or pause its tightening campaign. The International Monetary Fund had previously foreseen Germany as the sole major advanced economy facing contraction in 2023. Growth prospects for the Eurozone and the European Union as a whole have also been downgraded from earlier predictions made in May. While the Commission initially projected a 1% growth rate for the Eurozone in 2023, it has now revised this forecast to 0.8% despite avoiding a recession during the previous winter. The EU economy is grappling with multiple challenges this year, resulting in weaker growth momentum compared to earlier spring projections. The Commission's report also anticipates a slowdown in economic activity in the upcoming summer and months ahead, with continued weaknesses in industry and waning momentum in the services sector, despite strong tourism performance in various parts of Europe. Furthermore, Europe is not expected to rely heavily on strong export support due to sluggish global growth and demand. What are your thoughts on this economic outlook? Feel free to share your opinions in the comments section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.